Hello, ladies and gentlemen. I'm Yuri Bender, and I'd like to welcome you to the FT Studios for the latest in our Tea Break series of videos, where we discuss the issues of the day over a nice cuppa. Sadly, my co-host Ali has been called away on other duties today, but I'm delighted to introduce our special guest, Charlotte Thorne, formerly an economist with Her Majesty's Treasury and a family office advisor, now managing partner of multi-family office Capital Generation Partners. Welcome, Charlotte.
Thank you, Yuri.
And Charlotte, if I could start asking you, what kind of tea are you drinking today?
I've just gone for English breakfast tea, which is what I always go for, so no funny herbal business here.
Right, so you don't go for these sustainable brands, for this organically produced tea in line with your ESG credentials?
It's all very important, and I know that there's a thing about there's too much plastic, isn't there, in the tea bags? So we have to take plastic out of tea bags even. But no, I'm happy with a simple English breakfast tea, quite strong, not too much milk.
Interesting formula, that, Charlotte. I've been actually listening to the recent BBC Radio 4 series, The Empire of Tea, which has been very interesting because they talk about how the humble cuppa fueled the Industrial Revolution and the British Empire, which is why I'm following you and drinking a cup of the best builder's tea from the FT canteen with sugar, the kind of drink an iron worker would have drunk in the 19th century if we take ourselves back, because this new Labour government is very much trying to reignite this long-defunct industrial spirit in the UK with a massive infrastructure initiative. We've had a massive raft of new projects being announced this week. What's your view on this initiative, this policy, and how family offices such as yours can become involved in these investments, Charlotte?
Yeah, it's really interesting. I mean, it feels like we've actually spent the last 2 months or so telling the whole world how bad we in the UK are at infrastructure projects. So that may be true, I'm not sure, but what that does to appetite for investment in infrastructure is another question. Having said that, I do think there's a place for infrastructure investments in family office portfolios. But really not so much on the sort of opportunistic side. Clearly, these are very long-term investment projects. They're incredibly complex. Families aren't going to go into these sort of individually. You're going to want to partner probably with a fund manager. And if you're doing that, then you're going to want a fund manager of scale, of which there are some excellent operators. But I think the key thing about infrastructure in a portfolio context is it's going to be about some inflation protection over the long term, kind of fairly stable strands of stream of revenue coming to your portfolio. So that's the important thing, rather than, I think, for families, the idea that there's a new big exciting project that they personally can get involved in, because I don't think that fits very well for families and what they're looking for. But the inflation protection piece, yes.
But it's interesting, Charlotte, because the big banks, they've always sold that to the wealthiest families, and they've said, here's a new Spanish toll road we've got, or a redevelopment of an airport with some franchises there. This is ideal for the family. So that's kind of sold like another product line in some of the big banks.
There's always productification that goes on in the biggest financial services operations. They're packaging up opportunities in sort of kind of bite-sized chunks that are trying to make them appealing to families. But I think what's important for families is that investors generally, that you sort of stand back and look under the bonnet. What is this? What am I buying here? Am I buying some inflation protection? Am I buying a stream of revenue? Am I buying upside protection? What is it actually that I'm buying, rather than perhaps the excitement of a new bridge or a new airport or something like that, which ultimately is not, as an investor, what you're buying. What you're actually buying is the different characteristics of the investment that you've gone into.
But what's interesting, Charlotte, is that the investors coming in to the UK, for instance, there's a lot of foreign groups coming in as well. We've got the Middle Eastern logistics, cargo and ports giant DP World, one of the biggest port facilitators in the world, pumping $1 billion into the London Gateway port for the new shipping berths, the warehouses, and we've got the Spanish renewables utility, Iberdrola, I think, spending more than 10 billion on offshore wind funds, or so we're led to believe. Do you find this international dimension to these kind of investments?
From our point of view, CapGen point of view, our investors are global. So the UK is just one piece of the jigsaw for them, and actually a relatively small piece of the jigsaw. So we are looking for global opportunities, but indeed most investors these days are. Even if you are a pensioner with a UK-based pension, you're going to be exposed to international assets. And particularly when it comes to infrastructure, I think the important thing is you're going to need to find a global operator who's very comfortable moving across all these different jurisdictions and has specialisms in the area that they are accessing. This is not one for novices, obviously. So I think in that sense, it's very easy for banks to package that up and make it, an appealing type of product. But the most important thing, as I've said, is that investors look under the bonnet, understand who's managing these assets, and understand what the characteristics of that pool of investments will look like for them in their portfolio.
And the other real asset that families have always been interested in, obviously, is real estate. And we're seeing a trend now where people are moving away from perhaps the offices to data centers and other assets. Which are the key post-COVID trends which you're seeing amongst your clientele in this real estate market?
Well, you're right. Families have always been interested in real estate, and particularly if they're looking to deposit a significant amount of cash in the UK specifically, because it sort of feels like a safe haven from the perspective of certain other jurisdictions. So it's always been appealing from that point of view, just to talk sort of momentarily about the UK. And I think people are also aware that there's been, perhaps a bit of a repricing because of what's gone on in office particularly. But again, I think families need to be a bit careful here. So a lot has changed in this asset class over the last 10 years. So although we still get demand from families coming in, I want to buy a building in London, the journey that we might take them on then is quite different to the one we might have been on 10 years ago. And data centres might be part of that journey. So the things that have changed are, one, banks are not lending to the same extent in this space. And if they are lending, they're much quicker to get out if they feel there's a problem. Tenants are obviously far more demanding because supply and demand has switched around, so they have the upper hand. And the thing that's really changed, and I don't think is spoken about very much, is both tenants and governments are demanding a lot more in terms of ESG. So if you remember the last time you sort of had to go on the property market, you had to have an energy performance certificate. A rented out building, office building, from 2030 will need to have an EPC of B or above. 85% of UK stock at the moment is below B. So there's a huge stock of real estate which is not going to be lettable in a very few years' time. So you're going to have to go to your family investor who bought this nice building and say, by the way, you thought it was a one and done, you thought you had good tenants, okay, but now you're going to have to invest a whole lot more money, and it's not that your yield will improve afterwards, it's just to keep it rentable. So that is moving families on to different sorts of investments, and data centres is certainly one of them. I read a stat which perhaps everyone knows, but I didn't know, that a ChatGPT search takes 10 times more electricity than a Google search. I did not know that. And of course, that means that a data centre needs better energy infrastructure around it. And then, of course, because we're in an energy transition moment and everybody is very focused on the carbon challenge, you're going to need more energy transition infrastructure around it. So you sort of come back around to infrastructure projects, energy projects, when you think that you're just doing a real estate project. And all of this is quite a long way from your starting point of a family coming in saying, I'd like to buy a nice building in central London. So I think the message there is this asset class has become a lot more complex and a lot more challenging than it was. You can still access it, but you're going to need a lot more active management, a lot more selectivity. It's going to be more complicated for you than for your equivalent 10 years ago.
I'm curious, Charlotte, who's actually making the decisions for the family office? Who's advising them? And I wrote a piece this week about the senior people joining the family offices as chief investment or compliance officers. And it seems to be a lot of people now leaving the bulge bracket players, the JP Morgans, the UBSs of this world for calmer, more relaxed life, if I can say a more chamomile tea style life, where they've got flexibility in the family offices? Is this, and women in particular are taking this career path? Is this something that you're seeing?
Yeah, I think we've certainly seen that, and I can see the appeal from both sides. I think one of the things that families want almost above anything is loyalty, because obviously if you go into a family office, you have a lot of exposure to families, to individuals, to data, to sort of confidential information. So they really need to know that there's a loyalty and a trust there. So what they don't want is someone who's going to come in, do the job for 3 years and then move to another
So this
family.
is a bit like The Godfather. Never tell anybody outside the family what you're thinking.
You need to know when to say nothing, and you need to know how to behave with complete integrity and complete discretion. And I think so from a family perspective, someone at the end of their career is probably a good bet from that point of view. The most important thing is they're not going to go and leave to go to another family, because that would be, very Godfather inappropriate kind of behaviour. But of course, as well, when you bring someone in at the end of their career, what you're hoping to bring in is all of their accumulated knowledge and experience. I think that can work really well. I think the downsides of it, which are probably underestimated by both sides, is particularly on the banking side. If you've brought someone in from a bank, we can all see the benefits of moving from a big stressful bank to a family office. We can all imagine what those benefits might be. But I think on both sides can underestimate what the bank was doing for that relationship beforehand in terms of compliance and back office and flow. And if you brought a big deal maker in thinking that he or she will be able to replicate that when they're cut off from the bank, that can be disappointing on both sides. So I think as long as both sides go into it with a clear understanding that what we want is a relationship, a long-term relationship with integrity, and kind of candid advice, which, again, I think at the end of your career, you're in a better position to give than at the beginning, then I think it can work really well.
Although it's important to bring in people of all generations as well. And we've got an article, an opinion piece coming out this week, I think by the Chief Transformation Officer of a Reef. And he's talked about communication with younger clients through smartphones, instant messaging, podcasts, webinars, interactive platforms. Is this the way that you like to transmit ideas and analysis, or do you think there's no substitute for sitting down with a cuppa and discussing the big ideas with your clients?
Personally, I'm on the sit down with a cuppa end of the spectrum. But one change that we've made in our business actually is to facilitate our younger team to go out to do client work earlier on in their career than they might otherwise have done, because they're all incredibly capable. They're very skilled, and actually they do have people skills, and they can connect with a different group than perhaps I can. And what we've noticed about the clients is that clients at all ages are very comfortable dealing with younger people. They don't feel, even the older group don't feel affronted by that. They enjoy that kind of new sense of life and vitality, and also the idea that the organisation they're working with itself has a future and there's a long-term relationship there. So that's worked really well, just sort of empowering our younger team. We also do many more, as you know, and as you do, more podcasts, more video work. I'm wary about the phone aspect. Of course, we're regulated. We have to be very careful what information we're sharing over networks like that. So I sort of like to keep it relatively formal and on a relatively formal platform. But yeah, I think there is a need for us to become a bit more relatable in the way that we impart our information. And certainly it's been a long time since we've just kind of turned the pages on a slide deck with anyone. Nobody wants that really anymore, unless you're talking to a very institutional investor where they expect it. We all turn up with our slide decks and then don't open them. And I think that does speak to a change in the way people want to be communicated with.
Well, Charlotte, I know you've got a very busy day, so thank you for taking your tea break with us in the middle of the morning, and I'm sure you'll be back to join us soon in the FT studios, and my colleague Ali will be back with me next week. So ladies and gentlemen, and Charlotte, thank you very much for joining us for the PWM Tea Break.